$16 billion. In 1 year, Ken Griffin's hedge fund, Citadel, cleared more money than NASA's entire budget for reaching space, the largest annual profit any fund has ever booked. That $16 billion is what Citadel made in 2022, the year everyone else's money burned. The same Ken Griffin once sat before Congress under oath and said he simply plays by the rules of the road. 3 days before he said it, the buy button on the most famous stock in America had gone dark, while his firm sat on the other side of that trade. Go back to 1986. The Home Shopping Network, the channel you could flip to any Saturday morning, a host selling cubic zirconia rings with an 800 number crawling across the bottom of the screen, was the exact stock a Harvard freshman named Ken Griffin bet against for his first winning trade. He won. Then he got angry. Not at the market, at the broker's fee. Every commission-free trade you have ever placed on a phone, the ones that felt free, sent a fraction of a penny to a machine this man built. That was the point. Citadel Securities now touches roughly 1 in every 4 stock trades in America. I've read Citadel's own account of its worst night, and one line stopped me. It's not a number, it's that they wrote the whole thing down proudly. 3 collapses built this fortune. Enron, the crash that nearly buried him. GameStop, here they are in order. 53 firms now run the machine he perfected. I'll name the biggest later. And for a man whose whole life was removing single points of failure, there's one he could never remove. We'll get to it. So here's what should keep you watching. When the next panic hits your account, who is standing on the other side of your trade? And when the middleman who profits from your fear is the one man Congress can't quite pin down, who protects your money? He won in 1987. He won in 2008. He won in 2021. Every autopsy, every time. The middleman's cut. In the summer of 1987, a 19-year-old Ken Griffin took $265,000 of other people's money, his grandmother's savings among it, and started trading convertible bonds out of a Harvard dorm room. 34 years from that room, on one January morning, a button on millions of phones would simply stop working, and the whole country would point at the boy who started with his grandmother's trust. First, the bonds. A convertible bond is a corporate loan with a stock option welded onto it. Price both halves right, and you're buying dollar bills for 90 cents. In the 1980s, the big institutions couldn't be bothered to do the math. Griffin could. A retiree named Saul Golkin heard him explain it in a Palm Beach bank, listened for 20 minutes, and handed over his money on the way out the door. Every risk system Griffin built for the next 40 years came down to one promise: Grandma's money does not go to zero. Then the motor tested him. October 19, 1987, Black Monday. The Dow fell almost 23% in a single session, the worst day in its history. Fortunes built over decades were gone before dinner. Griffin, holding short positions, made money while grown men wept on the floor of the exchange. He was 19. He learned that panic is a transfer of wealth from the unprepared to the prepared, and every fortune he made after was that same lesson at a bigger scale. By 1989, a Chicago fund pioneer named Frank Meyer did what no serious institution does. He handed the 21-year-old $1 million and told him to trade. Griffin returned 70% the first year. In November 1990, with $4.6 million, he launched his own firm. 5 people, 3,000 square feet in Chicago's Loop. First full year, up 43%. The second, 40. The boy did not lose. Then he did. In 1994, the Federal Reserve hiked rates, stocks and bonds fell together, and for the first time in his life, Ken Griffin lost money, down 4%. 4% sounds like nothing. Investors ran anyway, forcing him to sell good positions at bad conclusion that would define the next 30 years. The enemy was never losing money. The enemy was his client's right to panic. That year, he renamed the firm Citadel, the fortress built to survive when the city around it burns. Hold that word. Locked. Because decades later, a man in Boston who trusted a star money manager would learn exactly what it feels like when the person on the other side of your trade gets to write the rules. In 1998, Griffin forced every client to choose: lock your money up for years or pay a penalty to leave. Hedge fund clients hold the leash. They don't wear it. Most of them accept it. Weeks later, long-term capital management, run by Nobel laureates and leveraged 25-1, imploded. Citadel's capital was locked. Citadel didn't have to sell a thing. It finished 1998 up 30%, and Wall Street handed it a nickname: the Grave Dancer. The fortress held. 10 years later, it would nearly become his tomb. The Grave Dancer's Bill. The letter came in the fall. 1 page. A client of Citadel opened it at his kitchen table. The doors were closed. He could not have his money. Not that week, not that month, not until the firm decided. He had trusted the man they called the Grave Dancer, the one who always won. Now his savings sat behind a locked gate, and the voice on the phone was a recording. The part that stays with me isn't the loss. It's that the lock had been in the contract all along, working exactly as written. He read the page again. He folded it in half. He set it beside the coffee cup and left it there, the way you leave a bill you cannot pay. Outside, the leaves were turning. Inside, nothing moved. The figure behind that letter was more than half of everything. Citadel's flagship funds fell 55% in 2008, roughly $8 billion of client money, and the gates stayed shut for 10 months. The man who profited from every collapse had become the collapse. Here is how the poison got in. In November 2007, Griffin led a $2.5 billion rescue of E-Trade, taking its rotting mortgage securities off its books. His public words were pure reassurance. The deal would, quote, restore confidence and return the company to strength. What he did not say: those toxic assets now sat on Citadel's own balance sheet, one carrying about $7 of exposure for every dollar of real capital. Within 12 months, the mortgage market collapsed. Those securities hemorrhaged, and they helped drive the firm's funds down 55%. The White Knight had carried the poison home. Then Lehman Brothers died, and the convertible bond market, the instrument of Griffin's boyhood genius, didn't fall. It closed. No buyers at any price. His brokers marked the frozen positions down anyway and demanded cash against them. At 7-to-1 leverage, that's the death spiral. Losses trigger cash calls force sales, sales deepen losses. By November, insurance on Citadel's own debt was trading worse than Lehman's had the Friday before Lehman filed. Griffin had wired a heart monitor to his own firm, and every trading floor on Earth could watch it fail. So he did the one thing a secretive man never does. He opened the gates and showed the granary. An open conference call, walking the market through Citadel's cash line by line. The rumors broke, but the arithmetic didn't care. Clients still wanted their $8 billion back, and honoring it meant fire selling into a frozen market, destroying several dollars for every one returned. So Griffin froze them out. The same clients already down 55%, now legally forbidden from rescuing what was left for 10 months. He put $500 million of his own principal's money in the same locked funds, a signal they were in the cell together. Judge it by the counterfactual. A fifth of all hedge funds died in that window, Many liquidated at the very bottom. Citadel's clients hated the lock. The lock is the only reason they got their money back. Both things are true. Then he rebuilt the machine from the studs, so no single trader could ever sink it again. He did not yet know the next threat would come from a message board, from millions of people who had never heard his name. The buy button. In 2020, as the country shut down, Citadel Securities booked record revenue of $6.7 billion because nearly every free trade placed on a phone that year ran straight through its machines. Griffin had rebuilt Citadel into the pod model. Dozens of small trading teams on short leashes, all watched by one central brain, so no single human could repeat 2008. While hedge funds lost 7% in the March crash, the flagship Wellington fund finished up better than 20%. Here is the part people never understood. Commission-free was never free. Brokers like Robinhood sold their customers' orders to market makers, payment for order flow, and the biggest buyer of those orders was Citadel Securities. You saved $5? The wholesaler monetized your order millions of times a day. Then, a dying video game retailer named GameStop became the most shorted stock in America, and a Reddit forum full of small traders noticed. They bought together and forced a squeeze. GameStop ran from under $20 toward $483. The most trapped short seller was Melvin Capital, run by star manager Gabe Plotkin, down 53% in a single month. On January 25th, Griffin did what he'd done to Enron, to Amaranth, to Sowood. He bought the distress, injecting $2 billion into Melvin. 3 days later, the button went dark. On January 28th, Robinhood and other brokers abruptly restricted buying, not selling, buying, in GameStop. Somewhere in Boston, a man who had followed Plotkin for years watched the squeeze reverse and lost thousands of dollars in one afternoon, with no one to call and no explanation that didn't sound like a conspiracy. The country connected three dots sitting side by side. Citadel had just bailed out the biggest short. Citadel Securities paid Robinhood about $140 million a quarter for its order flow. And Robinhood had just switched off the buy button. On February 18th, under oath, Griffin told Congress that payment for order flow was, quote, an important source of innovation, and that his firm simply plays by the rules of the road. Every fact he cited was legal. Every fact was disclosed. And everyone sat next to the $2 billion he'd just wired into the largest short being squeezed. Now the honest other side, because it matters. Robinhood's own clearinghouse demanded billions in collateral overnight as volatility exploded, and the undercapitalized broker restricted buying to survive. The SEC's own report pointed at that plumbing. Citadel even lost money on Melvin overall. No evidence ever proved Griffin flipped the switch, and he could have stayed silent, as he always had, and let the plumbing explanation stand. He testified anyway, and said the words that made him the internet's villain. Here is the gap that should bother you. The people who designed this machine sit in Miami towers. The man who lived with the buy button froze in front of a screen in an apartment he was still paying for. And that machine is not a relic. 53 multi-strategy firms now run Griffin's model, managing $366 billion. Izzy Englander's Millennium at $83 billion, Steve Cohen's .72, and the odds are strong that your pension or your target date fund holds at least one right now. When the next squeeze breaks, you'll be standing where the Boston man stood. He broke John Paulson's record the very next year. He did it in the worst market in a decade. Verdict. The button went dark on January 28, 2021, restricting buying, never selling, and within a week, the name Citadel was raised in the White House briefing room. Then, in 2022, while stocks and bonds fell together and the S&P dropped nearly 20%, Citadel's funds made $16 billion, the largest annual profit in the industry's history, breaking the record Paulson set in the crash of 2007. That $16 billion is the number from the very start of this story, more than NASA's budget for space that year, booked in the 12 months everyone else was bleeding. The lifetime tally now passes $90 billion, compounded at better than 19% a year for 35 years. 3 things built that, and each has a name.